Thanks for joining David, Kevin, and myself for the market update for the month of March. Lots of things going on, so I'm pretty excited to hear the two guys tell you all about it. As always, I hope you guys are all doing well. If you have any questions, need any help, please don't hesitate to give us a call. Take care. Off to you guys.
Thanks, Harry. How did investment markets perform in the month of March, Kevin?
Equity markets were kind of a mixed bag in the month of March, with some regions being positive and some negative. U.S. stocks, as measured by the S&P 500, were up about 3.5%. The Nasdaq was up 6.69% in March, notching its best month since June 2020 due to strong bounce in the technology stocks. In Canada, the S&P TSX was down slightly, about 0.6%, and markets outside of North America were mixed, with some Euro and Asian markets posting small gains while others had small losses. What was moving those markets in the month of March?
Well, as most people are probably aware and read about, there was a lot of headlines coming out of the United States around banks in March. Around the middle of the month, a couple of banks, one smaller and one sort of mid-sized bank, Silicon Valley Bank and Signature Bank in the United States, became insolvent after depositors at that bank, those two banks, began withdrawing funds in dramatic fashion, and basically the banks didn't have enough in assets to meet the redemption requests. And so people became, basically the banks became insolvent. There was immediate panic, of course, for a couple of days there. I think Silicon Valley Bank became insolvent on a Thursday, and then so that day and the Friday where there was quite a bit of panic. The markets were dropping around 2% per day, and financial stocks were dropping quite a bit more. Even our Canadian institutions, like the big five Canadian banks here, were being affected. Their stock prices, that is. And then the Federal Reserve over the weekend, on that Sunday night, basically said we are going to guarantee all deposits even if they're above that $250,000 limit, which they have in the United States. And so that quelled the fear quite a bit, and we probably would have seen a bigger run on banks heading into that week had they not done that. We were seeing a lot of deposits being removed from other regional banks. The U.S., like First Republic Bank, was having some issues as well. That has all since subsided. However, the two banks, Silicon Valley Bank and Signature Bank, are insolvent. The shareholders and the bondholders of those institutions have basically been wiped out. Now, moving forward, though, it seems like there's a lot more trust in the system again now that the Federal Reserve has guaranteed the depositors at those two institutions will be made whole. But it is, it did conjure memories for many people, seeing the markets drop, talking about banks failing. We were getting lots of questions, certainly too, from clients. And there was a lot, it was kind of reminiscent, I guess, for many people of the GFC, the Great Financial Crisis of 2008, 2009. People just worrying, what is this going to turn into potentially? Now, we think that that's probably in the rear view mirror now, but again, who really knows? But it's very unlikely that we're going to have a repeat of what happened in 2008 in terms of the banking system having major issues. The big five Canadian banks here, RBC, Royal Bank, CIBC, Scotia, and TD, are all very well capitalized. They have very stringent regulations, as well as the big U.S. counterparts like JP Morgan, Bank of America, Morgan Stanley, Goldman Sachs. All these banks are very well capitalized, and there's really no systemic risk. It's just some of these regional banks made some poor investment decisions and poor deposit management strategies that have kind of nipped them. So going forward, we don't expect any further contagion, and all these big banks that are in people's portfolios, like the big five Canadian banks and some of the bigger U.S. banks, we do expect them to be able to continue to raise their dividends as they have for many, many years. And we do expect them to be able to weather pretty much any storm that's thrown their way because of how well capitalized they are at this point. What else was driving markets in March, Kev?
Inflation again a little bit. Inflation did continue to trend downward, not quite as fast as central bankers would like to see, but overall inflation was kind of put on the back burner as many investors and even the Federal Reserve were preoccupied with liquidity issues at a lot of the U.S. banks due to the collapse of Silicon Valley Bank and Signature Bank, as David just discussed. We expect markets moving forward to refocus their attention on inflationary data and other economic data that can help provide hints as to where the central banks need to go moving forward as far as their monetary policy is concerned. Currently, bond markets are anticipating that interest rates do need to tighten slightly before year end, and then afterwards we should hopefully start to see some rate cuts being priced in 2024.
Yeah. Overall, the first quarter of 2023 is now in the books. It was a positive one. We do expect the market to probably trend positively going forward. The last 6 months, really, like Q4 2022 and Q1 2023 now have been positive overall. Of course, there's been negative months mixed into in the past 6 months, and there's always a negative news headline that's going to crop up pretty much every month. And so in the short term, it is a bit of a crapshoot. It's just last month's another good reminder that it's very difficult and it's fraught with risk in its own right to try and trade or make your investment strategy based on short-term news headlines, because one moment everyone was really worried about these US banks and stocks were selling off quite a bit there for a couple of days, and then the Fed steps in and everything recovers or stabilizes pretty quickly. So again, we prefer to remain diversified across asset classes, not being all in financial services or all in technology. We want to remain diversified, and over time we know that dividends will increase in these good businesses that you own, and over time your portfolio values will continue to increase. But we know it's interesting times right now. There's always lots going on in the market. So as always, if you have any questions how it all relates back to your portfolio, feel free to give us a call.
Take care.